CALGARY, American oil giant Devon Energy Corporation is the latest international producer to put its oil sands assets up for sale, but analysts think Canadian producers will be cautious about spending billions to buy the properties. Oklahoma City-based Devon announced Tuesday that the timing is now appropriate to divest from its Canadian assets, including the 100,000 barrels per day Jackfish thermal oil sands plant and other heavy oil properties, which account for 24% of the company's total production. If it is able to find a buyer for the assets, Devon will join a long list of foreign firms that have reduced their exposure to Canadian heavy oil, including Royal Dutch Shell Plc, ConocoPhillips Co, Murphy Oil Corporation, Marathon Oil Corporation, Statoil SA and Total SA. Over the past few years, oil majors have sold oil sands assets worth at least $33.6 billion, primarily to domestic producers, exiting mostly due to pipeline capacity issues and better investment opportunities elsewhere in the world, especially in the U.S. shale basins. There have been multiple transactions in Canada in the steam-based oil sands space of the last couple of years, Devon Executive Vice President and Chief Financial Officer Jeff Ritner said on an earnings call, but declined to comment on the company's asking price for the assets. In 2014, Canadian Natural acquired Devon's conventional gas operations in Western Canada for about $3.1 billion. The Canada Pension Plan Investment Board and Wolf Midstream Incorporated also spent $1.4 billion to buy Devon's half ownership of the Access Oil Sands pipeline in 2016. Devon said the separation or possible sale of the assets will enable it to complete its transformation to a high-return U.S. oil growth business. The company is also selling its Barnett Shale assets in Texas and focusing on other U.S. shale basins in New Mexico, Texas, Oklahoma, and Wyoming. Mike Dunn, analyst at Calgary-based GMP First Energy, said Devon's decision to sell its Canadian properties is not surprising, given the challenges facing the domestic energy sector. The trend is, a decade from now, the vast majority of the rest of the foreign producers are probably gone, he said. Devon's divestment of its oil sands assets is long overdue, said St. Louis-based Edward Jones analyst Jennifer Rowland, but the company is probably late to the game in getting out of Canada. Canada-headquartered companies have already spent tens of billions of dollars buying up oil sands projects from foreign producers and are now grappling with stretched balance sheets, according to Rowland. The trend is, a decade from now, the vast majority of the rest of the foreign producers are probably gone. Mike Dunn, analyst, GMP First Energy. Still, Devon's Jackfish property is considered a high-quality, reliable oil sands plant that will draw interest, as will the undeveloped Pite oil sands properties. I think the buyers will be there, she said. The company's Canadian assets could fetch between $7 billion and $9 billion, 8 capital analyst Phil Skolnick said in a note, or between $3.5 billion and $5.5 billion, according to a report by John Morrison, a CIBC capital markets analyst. In all likelihood, the Canadian assets will be sold at a price below what Husky Energy Incorporated was originally willing to pay for MEG Energy Corporation when it launched its $6.4 billion hostile offer last year, GMP's Dunn said. The price tag is probably lower than MEG's, according to Dunn. Husky ended up abandoning that deal even though MEG was unable to find a white knight to fend off the hostile suitor. Devon's oil sands assets aren't likely a strategic fit geographically for Suncor Energy Incorporated or Imperial Oil Limited, according to Dunn, while both Cenovus and Canadian Natural Resources Limited are still digesting their respective $17.7 billion and $12.7 billion oil sands acquisitions from 2017. That could mean Husky is a potential natural suitor for the Devon oil sands assets, as it operates in the same region and has the balance sheet flexibility, Dunn noted. CIBC's Morrison, however, believes Suncor, Canadian Natural, Husky, and Imperial could be logical buyers, but Cenovus Energy Incorporated is unlikely to bid as it works to pay down its large debt load. Suncor, Canadian Natural, Husky, Cenovus, and Imperial declined to comment. Email morgan@nationalpost.com. Twitter, Geoffrey Morgan. With a file from the Canadian Press.